to Thompson Hine's IM Coffee Chat. Today's topic is ETFs and exchange-listed products from crypto to complex strategies. So I'm Bib Stringe. I'm a partner in the Washington, D.C. office of Thompson Hine. I'm currently in Los Angeles in one of our offices. And Thompson Hine's investment management practice provides a multitude of services to mutual funds, ETFs, other investment companies. And in that position, we do filings and we see lots of products that are coming through. And of course, all of us have to keep up on the fast-moving regulatory world, including the SEC. So today we're going to focus on the expanding world of ETFs, mostly beyond exchange-traded funds. We'll touch on exchange-traded products, other types of funds. And as we'll get into, we're seeing more and more different assets underlying these products. The title mentions cryptocurrency, commodities, structured products, a wide variety. So we thought it'd be of interest to kind of catch up this audience on kind of the latest developments. So we have a nice group here today joining me. Megan Clement, like me, is based in Washington, D.C. We have Randy Gerlach out of our Chicago office, and Philip Sinanine out of our Columbus office. So quick housekeeping matters. Your microphone is turned off, so you can't interrupt us, but you can interrupt us with questions. So feel free on the Q&A to ask questions. Hopefully we can get to them. If not, we'll collect them. We'll talk about them either at the end. You can reach out to us by email, or we'll contact you somehow to answer any questions you have. So I'm going to read a quick disclaimer. I didn't memorize this, but please note that the discussion today is intended for general information of individuals and organizations on matters of current interest. It's not intended as legal advice, and participants should not act on information presented without seeking professional counsel. All right, got that out of the way. So let's get right into it. So let's turn to you, Philip. This general topic is market evolution and context. So give us a brief discussion of kind of the evolution of ETFs, from the beginning through 6C11 and beyond that point in time.
Sure, absolutely. Thanks, Bib. And I should add, these are our own opinions, and they're not the opinions of the SEC. Just kidding. Little tag on there. So to kind of go to Bib's question, it wasn't really that long ago that Rule 6C11 was adopted, and a lot has happened in the past 6 years. And I would say a bulk of the history of ETFs really has been post Rule 6C11. The proliferation of ETFs since then just shows what a powerful tool Rule 6C11 was, and also how strong the market is for ETFs. To put it in context for you, the number of registered ETFs available to U.S. investors has more than doubled since the adoption of Rule 6C11. So let's put a finer point on that. The first ETF was approved in 1993, and by the time Rule 6C11 came to pass, there were approximately 2,000 ETFs available. Today, the number of available ETFs is closing in on 5,000. So just think of that time from the time that Rule 6C11 went effective at the end of 2019 to where we are today. Just what a boom we've seen in the ETF industry. The defining feature of an ETF, namely being traded on an exchange, was not originally permitted under US securities laws. And so prior to Rule 6011, the SEC had to issue exemptive orders to allow ETFs to operate. Rule 6011 replaced those exemptive orders in an effort to provide harmonized relief and impose uniform conditions on ETFs. I should say ETFs organized as open-end funds, and I'll get into that a little bit because not all ETFs fall under the ambit of Rule 6011. So again, just for context, what did 6011 do? It treated ETF shares as redeemable securities to create a liquid product. It provided exemptions to permit secondary market trading of ETF shares at market-determined prices. And it allowed for in-kind creations and redemptions between affiliated authorized participants and ETFs. It also allowed for an ETF to delay satisfaction of a redemption request in the case of foreign investments where a local market holiday made timely delivery unfeasible. So these features together really streamlined the launch process and allowed ETFs to come directly to market without the cost and delay of obtaining an exemptive order. But it wasn't without a cost. It wasn't carte blanche. There were some conditions that were imposed on relying on 6011, and those are important to keep in mind. ETFs that rely on Rule 6011 must provide daily portfolio transparency. They must adopt written policies and procedures explaining the construction and the creation and redemption baskets, custom baskets, to make sure that they are in the best interests of the ETF and its shareholders. And I'll note that these custom baskets are really the core of 6011 because prior to the rule, APs would have to deliver a pro rata slice of an ETF's portfolio in exchange for shares. Although certain exemptive orders were giving some flexibility to ETF complexes and not others, and this disparity created a real disadvantage to those who were operating under more stringent restrictions on the baskets. So under 6011, ETF providers have the ability to provide a custom basket, which creates all sorts of efficiencies, including narrowing the bid-ask spread for investors, which is a key feature. And then finally, ETFs relying on the rule must disclose certain information on its website regarding premiums and discounts and bid-ask spreads, all designed to keep investors informed about the cost of investing in an ETF. As I mentioned, not every ETF can claim that the benefits of Rule 6011, or put another way, 6011 does not apply to all exchange-traded products. The rule does not benefit unit investment trusts, doesn't apply to leveraged and inverse ETFs. Non-transparent and semi-transparent ETFs must still seek exemptive relief. And at the time, Rule 6011 did not, it hadn't yet contemplated the now ubiquitous ETF share class that has been the topic of discussion for the greater part of 2 years. So kind of just going now in this post-6011 era, what have we seen in the ETF market? We've seen a number of trends. As I mentioned, the surge in the launch of ETFs is undeniable. And now that it's easier to bring an ETF to market. The last year, 2025, was notable for ETFs. It saw a record number of mutual fund to ETF conversions. The first of such conversions took place in 2021. And since then, 190 conversions have taken place, with most of them happening in 2025. 2025 was also the watershed moment where the SEC granted exemptive relief to order dual share class funds. In the time since 6011, we've also seen buffer ETFs. These are ETFs that offer cushions on both ends so that investors experience stock market gains up to a certain cap in exchange for limiting losses if they go below a specified buffer. We've also seen an increase in Section 351 conversions, which allow investors to contribute appreciated assets from private funds or separately managed accounts into a new ETF without triggering capital gains. These are all kind of becoming more and more common and issues that we are seeing often. That's not to say that single stock ETFs and semi-transparent ETFs have completely gone away. They're still they still have a place in the market, but that is to say that we've come a long way from simple index tracking ETFs. Let me maybe just to close out this evolutionary cycle, just maybe observe what some of the driving factors are for growth in the ETF industry. These are kind of informal factors, but and there's a lot of overlap here, but certainly choice is driving the growth in the ETF market. There are new product structures, new formats, new themes. And with all this added choice, I think there is a greater pressure for investors to really understand what they're buying before they invest. There's also a proliferation of information. The internet can be a very dangerous thing because everyone will have an opinion on different ETF products. And so investors really need to be aware of what they're investing in, because if you're looking for an opinion, you'll certainly find that opinion on the internet. Innovation has been a theme of this SEC. We're going to see I think, more tokenized ETFs, ETFs that center around digital assets and other non-traditional ETFs. There's certainly plenty of interest and plenty of runway for growth. The tax efficiencies are always going to be a compelling factor. And then finally, well, one kind of observation I'll make is, demand, pure and simple. Investors continue to seek out ETFs for their transparency and their liquidity and their efficiency. And they really are popular with younger investors and new investors who see ETFs as a vehicle for long-term wealth building. There's a strong conviction in the longevity of ETFs. And for investors in Generation Y and younger, those who are maybe perhaps younger than I am, they've basically grown up with ETFs in their entire adult financial literate lives. These are not new products that they're trying to understand. They've been with them for the entirety of their investing lives. So that's a little bit of the evolution from 1993 to present.
Thanks, Philip. And I'll just add a couple of things. One of the beauties of the whole ETF structure is the collegiality of all the different participants in the ETF ecosystem, if you will. And what is amazing too is the barrier of entry to get in this industry is extremely low. I think the advent and the growth of shared trust means you can come up with an idea for an ETF, especially contact a shared trust, and within a matter of 4 or 5 months launch an ETF. So it's always been easy to launch an ETF. What's interesting is you're starting to see for the first time a little stress on this ecosystem, and it goes back to the heart of the ETF, which is a basket of securities, and the create redeem process and the reliance on lead market makers and authorized participants to kind of execute that basic function with an ETF. And Philip mentioned the numbers, 5,000 plus, and it's starting to kind of stress that. So I only bring that up is that it's important, especially if you're kind of trying to launch a more esoteric type of ETF, to early on have communications with the lead market maker, because it makes that job tougher the more exotic the underlying asset is in the basket, because when they do in service and execute creates and redeems, they're always hedging. They're always trying to find these securities. So I just didn't want it to be cast that, every idea you're going to be able to launch it. You still have to be able to make sure it makes sense in the ecosystem.
That's right. I mean, I heard I heard a trustee just the other week say, not every strategy is ETFable. So let's not get too carried away and put everything in an ETF wrapper. And so some discretion and some prudence is certainly required. So I agree with that.
So moving on to kind of product structures, one of the things always been confusing is that the industry's never really adopted the protocol for names, really naming what an ETF is versus an ETP. I think for purposes of today, ETF, we're assuming the underlying asset are securities, thus they have to register under the 40 Act. You can also have exchange-traded products, ETPs, that do not have to register under the 40 Act, but rather they're registering their securities with the Department of Corporation Finance. And then there are also kind of a variety of types of ETFs, within that category. So, Randy, with that, tell us a little bit about some of the alternatives to the ETF structure.
Yeah, so there are a number of exchange-traded products for different strategies that are not ETFable, for example. Some of these being open-end funds, unit investment trusts, grantor trusts, limited partnerships, and then exchange-traded notes. So just kind of going over these. An open-end fund, that's going to be like your mutual fund. That's probably the most similar to an ETF. It is typically a registered investment company. The big difference being, unlike ETFs, it does not trade intraday. So it's traded based on the net asset value at the end of the day. So with this would come some concerns or something certainly advisors have to think about, in that making sure that there is liquidity for the fund to meet redemption requirements, which an ETF would not have to worry about. Obviously, the big topic, as Philip mentioned, is ETF share classes. Certain strategies work better than others in an ETF or a mutual fund. And something we'll see, I guess, going forward is how many of these funds that have gotten their exemptive orders actually implement an ETF share class from a mutual fund to an ETF or vice versa. Another product is a unit investment trust. This is a pooled investment vehicle, a registered investment company like a mutual fund and an ETF, except these traditionally have fixed portfolios. So usually before the UIT is launched, it has what the portfolio is going to be, and barring pretty unique circumstances, that portfolio doesn't change. So these are not actively managed products. Typically, they launch for either a 15-month or a 2-year period, with the idea being that a new, very similar strategy kind of starts just as the other one is ending, so an investor can roll their investment forward into the next one. One lesser known fact is that the SPDR S&P 500 ETF, SPY, is actually a UIT. And then sticking with trusts.
One quick point on that, Randy, because that's really interesting. You brought up the SPDR being a UIT, but before everybody runs out and says, well, that must be the logical choice when you're picking the form of the ETF. The QQQ, which came out shortly after the SPDR, just spent literally millions of dollars converting from a UIT to an open-end fund or a traditional ETF. So that kind of signals which type of ETF you should form.
Yes, certainly. Similar, another trust would be a type of a grantor trust. These are not traditionally considered investment companies under the 1940 Act. They're most commonly, they hold a specific pool of assets, such as like a physical commodity. And the investors of the grantor trust are viewed as holding a proportionate interest in the assets themselves for tax purposes versus holding a portion of the fund. So these are like pass-through entities. that being said, there are ETFs that are considered to be, are not RICs, but are grantor trusts. And then similar to a grantor trust in that there's a pass-through entity is a limited partnership. These are vehicles often used for exposure to commodities, futures, or other kind of alternative strategies. Also, like a grantor trust, not considered a registered investment company. And then the final product to kind of touch on is an exchange-traded note. And while it sounds similar to an ETF, these are actually debt obligations. It is a note typically with a financial institution like a bank whose return is linked to a performance of a specific index or an asset. Unlike ETFs and mutual funds, these notes don't actually hold the securities in the index. They are just linked to the performance of that index. So on top of market exposure, also getting the credit exposure, as with any debt obligation, to the financial institution, because there are no assets to sell at the end of the day.
And ETNs have not been very popular in the U.S., although they are probably the most popular form of exchange-traded type product in Europe. So, Philip, how should sponsors think about the structure in these decisions before they, launch their ETFs or ETPs?
Yeah, no, that's a good question, especially since it might seem, based on the literature that's available, that what haven't we put into an ETF? Right? There seems to be an ETF for everything imaginable under the sun: thematic ETFs, single stock ETFs, your plain vanilla passive index ETF, your active ETFs. There's a really broad menu for ETFs, and as we've all kind of underscored now, despite the popularity of ETFs, not everything is appropriate for an ETF. And Randy has gone through some of the alternatives to exchange-traded funds that might be a better vehicle for your product. But I think at the beginning of any kind of thought process, you have to think about what is the investment objective, what is the advisor or the sponsor, what are they willing to do, what do they want to kind of keep close to the vest, because ETFs do rely primarily on transparency and daily disclosures. So given that ETFs typically rely on daily disclosures of underlying holdings, a strategy that relies on a proprietary or non-disclosed picks to maintain an edge might not be suitable for an ETF. And I'm not saying that there are no such ETFs that are non-transparent, but it's something that to keep in mind. ETFs are traded continuously on the open market and are generally regarded as liquid. And so if you have in your portfolio a lot of illiquid investments, perhaps that's, again, not suitable for an ETF. As we'll discuss in a few moments, as investment strategies kind of veer from plain vanilla from the early 1990s and become more and more complex, and this is a point I think that Bib has also hinted at, managing capacity within an ETF framework becomes challenging as we get questions of scalability and suitability, and whether strategies with inherent capacity constraints are really appropriate for broad public distributions. So keep in mind that unlike a mutual fund, ETFs cannot soft close. So when a strategy outgrows its capacity, it can suffer a little bit from alpha decay, and it might threaten the viability of the long-term viability of that ETF. Also, ETFs, you purchase an ETF through blocks of shares in creation units. whereas mutual funds allow for dollar-based purchases in fractional shares. And that might provide other efficiencies in your context that make an ETF less desirable. If 401k plans already tax advantage plans, so perhaps they have less of an incentive to be in an ETF product because they already have the tax efficiencies. Or finally, as ETF share classes come online, I think sponsors need to weigh the pros and cons of running a dual share class and all the other aspects that add to having a dual share class versus running separate funds that are clones of one another. I think that's another point that sponsors will have to evaluate. And then finally, with Section 351 conversions, while those are attractive, there are also lots of considerations and requirements that need to be taken into consideration to ensure it complies with Internal Revenue Code. So these aren't just go forth and do it. Like you definitely need to be thoughtful about it and plan ahead.
Yeah, and I think another important thing to note is that the traditional ETF, 40 Act ETF, it's kind of the golden ticket on marketing because the whole back office system, brokerage platforms like Fidelity, Vanguard, Schwab, they're all geared toward ETFs. So it's highly accessible. Essentially, all a potential investor has to have is a brokerage account. These other structures, ETNs, LP, limited partners, LPs, grantor trusts, much more cumbersome, to try to market these products. But with that said, you can't just say, I'm going to be an ETF. There is a ticket to that admission. And, the first one is that it has to be an investment company under the 40 Act. So it has to have 40% or more of its portfolio in securities. So if you're trying to do a gold ETF, you're going to fail. You're not going to be able to register because you don't meet the definition of investment company. And like, Congress, when it enacted in 1940, the 40 Act, what it had envisioned as a mutual fund, same thing with the tax code. So the tax code is not going to eliminate double taxation unless the vehicle meets what it thinks is an investment company. And a big part of that is that it generates what is called good income, so income off of securities. So those are barriers that sometimes eliminate product ideas. I will briefly mention that there is somewhat of a workaround for these non-security assets that you can put in a Cayman sub and the fund, the ETF, owns shares in the Cayman sub, and you can meet both the definition of investment company and generate good income through those structures. So let's move on. Let's talk about some of the regulatory considerations and market trends going on with ETFs. And Megan, much has been discussed, especially about crypto ETFs. There's also discussions, with tokenization and getting tokens chained, on the blockchain. So how are these crypto tokenization, similar products, how's that kind of changing what the industry thinks about ETFs?
Yeah, so that's a great question. Crypto ETFs and tokenized products are really helping to bring digital assets mainstream by offering retail investors exposure to the digital asset space. And they bridge traditional finance with decentralized finance. Crypto ETFs are traditional ETFs that track the prices of cryptocurrencies, and they usually take two forms: spot ETFs, which hold actual crypto and track crypto prices, and then futures-based ETFs, which hold futures on crypto. So contracts to buy or sell crypto at a future set date and price. The price of a futures-based ETF tracks the futures contract rather than the actual crypto. In either case, the ETF investors do not actually own cryptocurrency, so they cannot transact in it. Crypto ETF shareholders, they will trade their shares on a traditional exchange, just like any other ETF, and hold their shares through traditional brokerage accounts. So that whole process is very, very familiar. With respect to tokenized products, we've seen tokenized money market funds hit the US market. Hopefully tokenized ETFs may be up next. Shares of tokenized funds are issued digitally. So shareholders will get a digital token representing their shares in the fund. And tokens, as we all know, are traded on blockchain rather than a traditional exchange and are held in a digital wallet. Tokenized funds also provide investors with the same market exposure that a traditional ETF would provide. It's just that their shares transact differently.
So one of the things I think we're seeing, obviously, from this SEC is our heavy focus on crypto, and there's jurisdictional kind of battles. They've reached an accord with the CFTC as to which type of crypto asset or would be regulated by each agency. You're seeing products where persons want to add on, some kind of benefit or even an income from a crypto. That's bringing in the banking agencies, like you're moving in on our turf there. So I think, right now, even though some of these things are getting settled, there's a lot of uncertainty right now in Washington and the whole regulatory front on how these products are actually going to end up being regulated, and then beyond that, putting them into an ETF or some of these other types of vehicles. Beyond crypto and tokens, you're seeing a variety of other types of filings with new instruments. One that we're seeing now are auto callables, which again are very complex. They are basically similar to bonds, but they offer a return that kind of comes from an index or some other underlying vehicle that stays within a band. They can offer very attractive yields. So the underlying auto callable is designed to kind of shift risk to the investors if there is a down market, and reward investors if there's an up market plus a nice yield. So they're able to kind of shift the risk around. But it's a good example of a product that's complex and that puts a lot of burden on the disclosure in the prospectus to describe it, as well as educating the board, and probably also since ETFs, there's no gating with ETFs like an accredited investor in a private fund. Retail investors can open up a brokerage account and get access to the auto callable ETF or other types of ETFs. So it puts a little burden also, I think, on education and how these products are marketed. I think when you're looking to launch a product like an auto callable ETF or other less routine types of ETFs, you're always concerned with valuation. You have to compute an NAV at the end of every day, and the more you have to rely on fair value, the more potential risk there is. And it's always, even though the SEC has recently scaled back its focus on exams in the areas it's covering, valuation is always front and center. As well as liquidity. And then, at the end of the day, like I said before, this is an ecosystem. So unlike a mutual fund, the life of an ETF really depends on being able to have a functioning create redeem process. And the more liquid the underlying baskets are, the better that functions. And the SEC, and Philip mentioned 6011, the SEC forces you to put bid-ask prices up on your website every day, the spread between your NAV and the share price. And as those widen, it sends a signal that this isn't really a well operating ETF, because the market is perceiving some kind of risk in the underlying baskets. So there's a lot of things to consider when you're deviating from a kind of a run-of-the-mill equity or fixed income type of ETF. So let's shift to what lays ahead with ETFs, pulling out the crystal ball, the future landscape. And maybe I'll start with you, Philip. What are the types of strategies, structures that are starting to gain regulatory traction with the SEC and getting the green light?
Sure. Certainly, I think we're going to see the expansion of the ETF marketplace. As Megan pointed out, tokenized ETFs are nearing the fore. Maybe we're not quite there yet, but I imagine that we will see more discussion and more questions being raised with tokenized ETFs. I think crypto ETFs are ready to breach the dam as more crypto companies go public and traditional firms are adding cryptocurrencies to their balance sheets. We can expect to see a new wave of ETFs designed to capture the growth of these digital assets. I also think that given some of the tone of this current SEC and the themes of this SEC of kind of democratizing access to private markets, that we might even see private assets as a growing segment of the ETF industry, of using ETFs to facilitate exposure to private assets for the retail investor. And so I think all of these types of investment themes we'll continue to see. And then maybe I would say inflation-resistant ETFs, given the geopolitical situation and the uncertainty of global markets. It seems that gold ETFs, for example, provide some measure of consistency and perhaps comfort in an otherwise, unpredictable world.
Yeah, and I think it's interesting to kind of, for the audience to get a feel of the ETF and where it's been is important to where it's going. And I can say that I've seen it all. I was at the SEC when the first exemptive application came in for this product, and you think some of the ETFs we've talked about today are exotic. At the time when that hit the commission, that was out of space, to take a portfolio of securities, essentially a mutual fund, and trade it on an exchange. And there's been ever since that first day, there's been a very cautious attitude by the SEC because of the uncertainty. And I think what's interesting is the ETF didn't come out of thin air, if you will. The gentleman that started it, the first one, Leland, O'Brien, and Rubenstein, who had nothing to do with State Street, by the way. They're a group out in California. They had come from the institutional world. And I think that's interesting because now you're seeing a lot of products that have come from the institutional world and are making their way into retail ETFs. So essentially, the idea came from Leland, O'Brien, and Rubenstein were trading baskets of securities because the computers had caught up with being able to facilitate those trades, and large insurance companies, for example, didn't want to have to go out and buy themselves all the individual components of the S&P 500. So basket trading was going on. And as we, whenever you talk about the create and redeem process, it's a basket security. So, in the ETF itself is not a simple product. I think people lose sight of that. It came from the institutional world, and it heavily depends on the arbitrage process, and that's what the SEC was convinced finally to allow it to be offered after years of study. And then it was kind of a slow evolution. The first, like we've mentioned before Rule 6011, you needed exempted relief. And that was basically a tool for the SEC to control the type of ETF products. It slowly came to the conclusion that fixed income ETFs were okay. Further down the road, actively managed ETFs. And then, each step was a couple of years of study going back and forth. So a lot of these ideas you're hearing now were percolating back then, but there was no ability to try to get an exotic product through the SEC. And then, towards the end, right before 6011, you started to see the leverage ETFs, the 2X, 3X from pro funds, which had done those in mutual funds as well. So, 6011 was, as Philip mentioned, was a big game changer. Now you didn't have two offices. You had to get an ETF product through. You only had one office, and technically they had 75 days to think about your product or let it go. As we all know, they came up with a crafty way to extend that. So don't have any hopes if you're going to launch something exotic that you're going to be able to get it through in that short time frame. So, I think the SEC was rightfully so in being conservative. And then I think, anytime anybody is going to launch something other than a kind of a run-of-the-mill ETF, they should have the same thought process. How's this going to work? Is it may be the greatest idea in the world and produce this greatest yield, but how's it going to function day to day? And is there buy-in from the lead market maker? And has all the potential tax issues been discussed? Have you talked to your auditor about it? And so I think we're going to continue to see products that continue to push the envelope, because what we're seeing is like, for example, insurance company general account management. They use a variety of tools to manage, trillions of dollars, if you will. And auto callables kind of came out of that world. Corporations use a variety of structured products and things to manage maybe their cash flow. And ideas are coming from there. Wall Street, always launching products for their institutional clients. all these are starting to creep into the retail world. A lot of hedge fund strategies. They're basic, covered call and things like that, but again, they're leaking into this world. I think Philip mentioned buffer ETFs are another one, defined outcome. You can imagine, the creativity out there and even the mathematical minds that are coming up with these products. And I think what's going to be interesting is, again, it's easy to get an ETF launched these days, but making sure, the board is educated about such a product. They reach a comfort level. And frankly, it's within their risk parameters as being the group that oversees the fund complex. And I think there's a real, there's never been, except for the highly leveraged products, there's never been really much issues with kind of FINRA on these products and diligence. But I think you have to be mindful of how these products are going to be marketed, including your website, your sales materials, making sure they're filed with FINRA. And when the ETF first came out, again, it was a complex product. Some of the early groups like iShares spent lots of money and hired lots of people to educate financial advisors about what an ETF is, and giving thought as to whether similar types of educational, whether it's a video on your website or somewhere face-to-face webinars, even to educate people on some of these products that are pushing the envelope. And then, as I mentioned before, I mean, you always have to make sure these products are going to comply with the tax code and subchapter M.
Right, and Bib, I might mention, if we started off with what has been greenlit or what has the go-ahead or might soon get the green light, but I think you've underscored some areas that have definitely gotten a red light, or at the very least a caution or an amber light, because it is not all it's not always all systems to go. You mentioned leveraged ETFs. And then I'll just note that the SEC recently drew the line at double leveraged ETFs, 2x, and in a kind of unusual move, hosted a call, a one-way call, as I've heard it described, where they pretty much said no to 3x or upwards, anything higher than 3x for levered products, signaling that that this SEC is still cognizant of risks, and is not willing to bet an investor's savings on levered products. And along with that, I'll note that last week, prediction market ETFs, which seems to be another type of I won't call it a risky investment, but it involves a little bit of a gambit, were also delayed last week. And these investments are tied to predictions of the outcomes of U.S. elections. And the SEC wants to hear more about what exactly that means and how that plays out. So to your point, Bib, and Megan, as you were describing, some of the features of tokenized assets and what still has yet to be decided upon and what has to come to pass, there is still some caution with ETFs.
Yeah, and those are great examples. And I think one of the reasons the SEC it took them a while to allow crypto trusts, grantor trusts, not ETFs, where you had iShares and others, and Fidelity, having a pool of crypto and offering interest, was the fact that the underlying product, crypto, was not regulated, nor was the exchange or the medium in which it went from buyer to seller and back, was that regulated? And I think you're seeing that probably the underlying reason there's a pause on these predictive ETFs is the same thing. It's not regulated. People are reading in the papers of accounts where persons have even been charged under the securities law for manipulating a particular or engaging in fraud on the buyer with respect to these products. So, yeah, I think there is. It's good you brought up, because I think people have the impression that since the Trump administration came into office, Paul Atkins and his background, that the theme was going to be innovation. And I think that still is the theme from the top down, with an emphasis on innovation with crypto and tokenization. Obviously, you saw the example of 401ks being able to invest in private equity. That's definitely the theme up there, but they still totally understand their mandate, which is to protect investors, and that's
and
why
I would add AI themed ETFs. I mean, that's perhaps the white elephant or the pink elephant in the room. How AI is kind of slowly taking over all of our discussions in the industry, and I think AI themed ETFs, not just as an investment itself, investing in AI companies, but also the use of AI and managing the strategy. Those are all kind of it's in the near future. We're going to see more and more discussions and debate on what's appropriate for an ETF and what's an appropriate way to manage an ETF using AI as AI itself continues to grow.
Well, yeah, and you're already seeing that to some extent in that, what are the hot companies in the near future? Most of them are still private, not for long.
Right.
SpaceX and the whole laundry list, and the desire for ETFs to be able to access those early, even after the IPO of these. If you're a thematic ETF, you're subject to the names rule, and 80% or more of your portfolio has to be consistent with the name, and kind of the hallmark test when looking at a company is the revenue that's being generated, by the company, and whether that is consistent with the name. Well, a lot of these companies that are going to be evolving and coming out with IPOs, they may not meet some of those tests, and so there's kind of a push-pull with the SEC in trying to get those products through. So I think it's worth mentioning when you talk about the SEC and having been there, and it's dramatically different than when I was there. You have the top down, what they're pushing down to the staff as an important. Believe me, when I was there was no top down or bottom up. They didn't really care about us. We regulated this industry called the mutual fund industry, which was not of great importance like it is now. So we have the top down, but I think what's interesting, is obviously the bottom up. When you file something, it's reviewed by an examiner, and it never gets through unless the branch chief signs off for it. So, usually you're within that world, the branch chief and the reviewer, and you're making arguments. But as you get to more exotic type ETFs, then it's going to bump up another level. And they seem to have these little groups, guardians or whatever, that it's not a organizational chart that goes straight up, but rather you have the crypto experts. And so now the branch chief has to bounce it off the crypto experts. And then, eventually, if it's something new and different, it has to go up to the assistant director and then potentially the director. And then, in the extreme, it may have to go up to the full commission. So just bringing that up to say that if you think you're going to be able to launch some of these products within 75 days, there are limits. And again, it goes back to the 4X and 5X group. They obviously went through multiple levels and somebody said, stop. This is not going to happen on our watch unless we have further study and we're able to, to get comfort with it. So with that said, I think we've kind of covered the landscape here. And I will say, in closing, first of all, thanks everybody for attending this. This session is recorded, so people out there who are not here will have an opportunity to review it. And we posted it on a variety of places, including YouTube. This is one in a series of coffee chats. There have been coffee chats in the past. There'll be more in the future. So you're able to kind of subscribe to the coffee chats and get a heads up when we're going to have our next one, which will actually be June 3rd. So we're just going to be a totally different group. The title is Enforcement Risk and Operational Resilience in the Digital Assets Marketplace. So we touched on a little bit on the digital assets. And then we also have a survey at the very end. So if you have time, we welcome feedback and please submit any comments and ways we can improve. And then I'll mention, any questions. Obviously, we didn't get to questions today. We will look at those questions and we'll get back to you. If we haven't gotten back to you, you know where to find us. Feel free to send an email to us. And so that concludes our coffee chat for today.
Have a great week, everyone. Thank you.